The shift began while markets were still behaving, while contracts cleared and supply chains moved as planned, but something subtle had already detached from policy and reattached itself to advantage. Capital didn't wait for confirmation. It adjusted in real time, drifting toward cheaper certainty and away from political intention. By the time analysts tried to reconcile prices with announcements, the movement had already completed its arc, leaving behind a system that still functioned perfectly well, except for the fact that the logic it was built on no longer applied. Donald Trump was calling it an A+++ economy. In public remarks throughout 2025, he insisted the tariff war had finally bent the global system to America's will. Factories would return, China's exports would collapse, the United States would reindustrialize on its own terms. The confidence was loud, the data underneath it was not. By mid-year, Bloomberg data showed U.S. growth was coming from just 4 places: healthcare, government spending, real estate, and technology. Outside those sectors, the economy was shrinking. Manufacturing output was contracting. Construction activity was rolling over. Export growth, the entire justification for the tariff strategy, was absent. Multiple economists quoted by the Financial Times warned that without the AI-driven tech boom inflating earnings and valuations, the United States would already be in recession. Tariffs were not reviving industry, they were compressing it. Reuters reported that higher duties on steel, electronics components, and industrial inputs were being paid by U.S. firms themselves. Domestic suppliers raised prices to cover higher costs and protect margins. Those increases rippled outward. Making goods in America didn't get cheaper, it became structurally more expensive. That was the gamble of 2024 and 2025. The United States weaponized its consumer market, betting Americans would absorb higher prices long enough to break China's export machine. Allies would relocate factories. China would lose demand. Decoupling would finally work. What followed instead was a rerouting of the entire system. China didn't fight for the United States consumer. It replaced it. Customs data cited by the Wall Street Journal showed China closing 2025 with a record trade surplus of roughly $1.2 trillion. Overall exports rose more than 6%. Exports to the United States fell by about 30%, but shipments to Europe climbed. Asia absorbed more volume. Africa exploded, with export growth exceeding 20%. Beijing didn't slow down. It changed direction. That shift mattered more than the tariffs themselves. The more China exported to the rest of the world, the less leverage Washington retained. Bloomberg noted in a late-year analysis that China had demonstrated its export economy could survive and even expand without the United States market. Sanctions work best when dependency is singular. China's wasn't. Those exports carried a second effect that caught policymakers off guard: deflation. Chinese goods pushed prices down across emerging markets and parts of Europe. IMF tables released in its autumn outlook showed Chinese manufacturing capacity becoming one of the largest sources of global disinflation pressure. For countries fighting inflation, that was relief. For the United States trying to rebuild industry behind tariff walls, it was poison. Western governments noticed. France quietly deepened commercial engagement with Beijing. Canada followed. Mark Carney understood the constraint. Access to Chinese supply chains mattered, but access to Chinese consumers mattered more. China was no longer just the factory of the world. It was the demand center. The scale was impossible to ignore. Data cited by the Financial Times showed China's e-commerce market reaching roughly $3.4 trillion last year, nearly triple the size of the United States online retail sector and about 40% of global digital commerce. Western companies still wanted exposure, not because of ideology, but because of arithmetic. At the same time, the United States was importing less from the world. That asymmetry shifted pricing power. China gained it. Washington lost flexibility. And that loss of flexibility cornered Trump. Trump didn't soften, he hardened. In speeches and interviews, he dismissed critics as pro-China, arguing tariffs were paid by foreign nations and middlemen, not Americans. He waved off economists and invoked history. Yet the evidence moved in the opposite direction. The New York Times summarized multiple studies showing tariffs raised costs for U.S. importers and consumers. The burden stayed domestic. Trump couldn't reverse course without humiliation, but continuing meant China's advantage kept compounding. China's strategy had never been consumption-led. It invested more and consumed less. Rising labor costs at home didn't weaken it. They pushed Chinese firms to build factories abroad, across Southeast Asia, Africa, and Latin America, while retaining ownership, financing, and control. Since the pandemic, that model accelerated. Chinese exports climbed steadily after 2020. The 2025 tariff escalation didn't slow them, it concentrated them. Imports from the United States fell, export earnings surged, Beijing kept the surplus. Forecasts cited by Bloomberg now point to China's trade surplus climbing toward $1.4 to $1.5 trillion. Many exporters are state-owned or state-directed, allowing profits to be steered into strategic projects instead of dividends. That money didn't sit idle. Chinese firms poured capital into lithium mines, copper processing, gold projects, and rare earth refining. Energy infrastructure followed: power plants, refineries, solar installations, especially across Africa and Asia. The building blocks of the modern economy increasingly ran through Chinese balance sheets. The stress showed up in places tariffs were never supposed to touch. By late 2025, U.S. capital spending surveys cited by the Wall Street Journal showed manufacturers freezing expansion plans, not because of weak demand alone, but because input pricing had become, well, impossible to forecast. CFOs described a planning environment where steel, electronics components, and energy costs could swing violently quarter to quarter. The tariff wall didn't create certainty, it destroyed it. That uncertainty collided with the AI boom itself. Nvidia's revenue surge masked broader weakness, but even that engine was showing strain. Analysts quoted by Bloomberg warned that hyperscaler demand was front-loaded, pulled forward by panic buying and subsidy arbitrage. Once those build-outs slowed, domestic chip demand would flatten. Without China, there was no second engine waiting. That cliff mattered because Nvidia's Blackwell and Rubin roadmaps depend on continuous cash flow, not one-off surges. China saw that vulnerability clearly. Huawei didn't try to beat Nvidia head-to-head on performance. It went after deployment density. Ascend chips were rolled out across state-backed cloud platforms, telecom networks, and industrial AI systems where cost efficiency mattered more than peak benchmarks. Reuters noted that Chinese firms were optimizing software stacks around domestic hardware, reducing reliance on foreign chips even faster than Washington expected. At the same time, Beijing tightened its grip upstream. Mining agreements signed across Africa bundled lithium, copper, and rare earth access with infrastructure financing. Chinese refiners locked in long-term offtake agreements that Western buyers couldn't match without state backing. Those deals didn't just secure supply, they set pricing power years in advance. That power spilled directly into silver. Logistics firms reported chartering additional cargo capacity specifically for bullion flows to Asia. Insurance rates rose. Vault inventories in London and New York thinned. The Shanghai premium wasn't a signal, it was a magnet. Industrial buyers in China treated silver the way energy traders treat oil ahead of a supply shock buy first, argue later. Washington's pause on silver tariffs exposed a deeper constraint. Tariffs work when substitutes exist. Silver has none at scale. Solar manufacturers warned privately that any sustained price spike would force production cuts or price hikes that consumers wouldn't absorb. That pressure landed just as renewable deployment targets were accelerating, locking policymakers into a corner. Trump's broader tariff posture began to fracture alliances as well. European manufacturers complained that U.S. protectionism was pushing them closer to Chinese suppliers by default. French industrial groups quietly expanded sourcing agreements with Chinese firms, prioritizing cost stability over political alignment. Mark Carney faced similar arithmetic in Canada, where resource exporters saw China as the only market capable of absorbing scale without punitive trade friction. Markets reflected the contradiction. Equity investors rotated defensively. Bond traders priced in policy error. Commodity desks treated volatility as permanent. Nothing was stable, but everything was connected. Tariffs reshaped flows. Chip taxes redirected innovation. Silver exposed scarcity. And China, sitting at the center of those loops, kept accumulating leverage. The system didn't snap, it bent. And in bending, it revealed which side had room left to move. Then Washington opened another front, and this one cut inward. In 2025, the Trump administration imposed a 25% export tariff on advanced chip sales to China. This wasn't a sanction on Beijing, it was a tax on U.S. companies. Nvidia, the centerpiece of the AI boom, would surrender roughly $2.50 of every $10 earned in China to the U.S. government. That revenue didn't vanish. Much of it would end up funding U.S. military expansion. The irony was sharp. Nvidia sold to China because it needed scale to fund research and development. Its Blackwell and Rubin architectures require enormous capital. Redirecting that revenue weakened the very edge Washington claimed to defend. China responded without mirroring the move. It let its companies keep their earnings and added subsidies. Huawei and other domestic chip makers expanded funding. Reuters reported that Chinese authorities quietly signaled customs officials to slow or block approvals of Nvidia shipments, leaving U.S. firms in limbo. Beijing didn't need a ban. Uncertainty worked just as well. At the same time, Trump pushed to relocate Taiwanese semiconductor production. He touted two commitments, $250 billion from companies and $250 billion from government support to bring the supply chain to America. The numbers sounded historic. The economics were unforgiving. Domestic production raised costs. It didn't create demand. China still represented roughly half of global semiconductor consumption. U.S. firms couldn't replace that market at home. As revenues tightened and costs rose, innovation slowed. Chinese alternatives advanced in the gap. Huawei's Ascend chips lagged Nvidia on raw performance, but they were far cheaper. Analysts cited by the Financial Times noted that Chinese firms could scale quantity while closing quality gaps over time. Cost efficiency mattered, systems mattered, subsidies mattered, and then the system cracked somewhere else entirely. Silver. By mid-2025, silver prices began behaving like a tech stock. 5 to 10% moves in days became routine. Shanghai prices traded as much as $13 to $15 an ounce above Western benchmarks. This wasn't speculation, it was panic. China and the United States were chasing the same metal. Silver is critical for electronics, photovoltaics, and advanced manufacturing. China, the world's largest solar panel producer, faced a supply squeeze it couldn't substitute away. Industry data cited by Bloomberg showed silver's share of solar panel costs had exploded, from about 3% just a few years ago to roughly 25%. Copper couldn't replace it without sacrificing efficiency and lifespan. Manufacturers had no choice. They had to lock in supply. So they rushed. Physical premiums in China surged. Traders shipped silver east at scale. A $15 spread on a $90 base price was irresistible. Western inventories drained as metal flowed toward Asia. Washington noticed too late. The Trump administration delayed tariffs on critical minerals, including silver. Officials understood the math. A 20 to 30% tariff would spike domestic prices, hammer manufacturers like Tesla, crush renewables, and punish consumers. Imports surged anyway. Volatility fed fear. Fear fed demand. Investors and industrial buyers hoarded silver because tomorrow felt unreliable. Prices swung harder. Buying didn't slow. By late summer, the picture was unstable. U.S. markets wobbled. Chip companies faced margin pressure. Precious metals traded like growth assets. China's export machine kept running. Its capital stock kept rising. Its leverage kept compounding. Nothing had officially collapsed. But the system was straining under contradictions it could no longer hide. Tariffs didn't cripple China. They accelerated its rerouting. Chip taxes didn't secure dominance. They financed competitors. Silver exposed how thin the margin for error had become. The conflict wasn't stabilizing, it was intensifying, and the markets weren't waiting for policy to catch up. Please like and subscribe. Leave your thoughts in the comments. Your support helps us grow. Thank you.